Hey everybody, Doug Robertson here for Top Gun Options, Full Throttle. It's been a long day. Hey Andre, Lee, how's it going? Excellent. All right, let's see. All right, everyone's filtering in. Welcome to session number 7. We are actually this is lining up really good tonight. This is just about I didn't actually plan this, so I can't really take any credit for this. This is lining up just about perfect with a series of trades that are popping up right now. So we are going to be discussing volatility trades tonight. And volatility trades are a huge subject. There's all kinds of different ways you can do them. There's all kinds of opportunities. There are all kinds of different types of volatility trades. But what we're going to be doing is we're going to be building on the calendar trade concepts that we had last week, and we're going to take it a little bit further. And by using events like earnings announcements that drive volatility way up, we are going to be able to create specialty trades that are a really powerful category of trades. And so looking forward to it. Not so many slides tonight. We're really just going to dive into the trades and dig into some ideas. Should be a fun one. This is kind of the culmination of the trade tactics that we go over. Next week, or excuse me, not next week, this Thursday. God, I got to remember where I am. This Thursday, we're going to be wrapping up the series. We're going to have we're going to have a session that's over a broad series of topics. We're going to be reviewing some things. We're going to be talking about portfolio theory. We're going to be covering any questions, and it's going to be our last one. It's amazing how quickly it feels like we've just suddenly got here, and here we are, 8 sessions in. So I guess, as we always do, I will skip over the disclaimer before we get going. Does everybody hear me fine? Can everybody hear and see the screen okay? A quick little hello from everybody here. 5 by 5. Yes, yes, excellent. All right. Okay, good. Let's get rolling. All right, hold on. Let me just take care of something real quick. There we go. That's what I was looking for. Okay. As always, we have to appease the lawyer gods. So, access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trade. All securities and orders discussed are tracked and monitored in virtual trading, paper trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither Top Gun Options, TGO, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk, and options may not be suitable to all investors. Visit the OCC website at www.optionsclearing.com to read characteristics and risks of standardized options. DGO provides educational and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money you can't afford to lose, and make all trades in the TGO program in a paper trading account. Past performance does not equate with future results, and results discussed in this webinar are not necessarily typical. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss or losses you may incur from information discussed in the media identified above. Yay! Yeah, I know, Christine. It always feels that way at the end. It's funny when I get going on these things. At the beginning, it seems like this monumental task of all of these classes and organize all this stuff and kind of work through all of these things, and it's a bunch of work. In the beginning, it looks like this huge mountain of stuff. At the end, I'm looking back, and it's like, wow, where did it go? It's kind of it's it's kind of crazy, but what is good is that when we're done these, you can all participate in the live trade briefs, and we can turn some of the ideas that we were working with here into trades. Because the stuff I teach, this is the stuff we use. This is the things we use on a regular basis. So it's you know, teach you the ideas and then put it into play. So tonight, volatility trades. And for those of you who've been around me long enough, I'm sure you've heard this phrase many, many, many times. I swear it's almost turning into a catchphrase for me. Fear, uncertainty, and doubt. The FUD factor. I don't know why I grabbed onto that idea so much, but it really sums up a lot of what options trading is actually about. We're not, in some ways we're trading option or stock prices moving up and down. And sometimes we're trading time erosion, things like that. But a big chunk of everything we do, the longer you get into it, the more focused you become on fear, uncertainty, and doubt. Implied volatility changes. And it's where you start to find, entire categories of new trades, new thoughts, new ideas that allow you to make money in a variety of different ways. And if I can expand my trading approach from I can make money if a stock goes up and I can make money if a stock goes down, to making money when it goes sideways, and then finally making money when the volatility changes, and then even better making money when volatility goes absolutely nuts because of crazy different events. I've got so many different ways and so many new approaches to making money that I can find good opportunities all the time. I can find all kinds of different ways of, turning my nickels into dimes. And that's what I want. So tonight, we are going to expand on last Thursday's class. Thursday we were talking about calendar trades. Now, hold on. Let's just take a look at some things going on here. Calendar trades are an interesting class of trade. They use implied volatility changes as well as price movement and as well as theta erosion all together sometimes to create trades that can be very profitable. They can be exceptionally profitable. But they're all built around the idea that implied volatility is moving together. And that's true most of the time. You actually see volatility generally moving roughly together. The long-term options and the shorter-term options both change implied volatility at roughly the same rate. And we can expect to see that. But that's not always the case. And there's whole categories of times when you can actually manipulate a trade to really, really work amazingly well in a different way. In fact, you can turn calendar trades into a whole different class of trades. In fact, even going in different directions than you might have expected from our other classes. So tonight, what we're going to do is we're going to dig into that. Now, the most obvious example of what I'm talking about is earnings announcements. And luckily, we are literally diving into one of the early big weeks in earnings announcements right now. So we're going to have a ton of examples to work with. And now, not that I normally focus on trying to knock out trades during these classes, but I actually think that we're going to be looking at a couple of symbols right now, just as examples that I actually completely expect to be using as trades tomorrow. So let's kind of discuss some of the concepts. Now, we know with a calendar trade that if we can put on a calendar trade when implied volatility is low, and whether it's a bull call calendar, bear put calendar, whatever you want. I mean, it doesn't really matter too much what it is. If you set up the trade well and the implied volatility is low when you put it on, you can create a system where as implied volatility increases, it multiplies the profitability of the trade. It makes it surge to huge levels and allows you to make a lot of extra money. If you're smart about how you do that, you can also use that to take advantage of or manipulate the effect of market corrections and crashes to offset risks you have in other parts of your portfolio. You can use the implied volatility from a correction to drive the profits in a trade that offsets the losses in other trades and actually makes your portfolio more stable and more stronger and more powerful. More able to consistently generate results for you. Now, that is great, but now we've still got this thing within all of these trades where you've got one side of the trade that's kind of hurting you and the other side that's actually helping you. And that's where we suddenly start to get into this whole category of earnings and events trades. So let me show you something about earnings announcements. And you guys are smart. You've been a great group, by the way. I've really enjoyed working with you and, having a good constant stream of questions and ideas and thoughts, and challenging me on different things to come up with answers has been fun. Really, really like that. So I think you're going to get this idea pretty easily. And I think some of you have seen this. We've actually done some of these trades. But earnings announcements create a very, very special situation in the market. They're not unique. There's other situations that do similar things, but they do something kind of special for us. And that is creating very, very consistent changes in implied volatility. Figuring out what a price is going to be at a certain point in time is hard. Very, 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 very hard. On the other hand, when we're dealing with earnings announcements, figuring out what implied volatility is going to be is actually relatively easy. We can create a process around it. It's not a really complex process. It's just a bunch of steps that we've got to go through. And once we check off the boxes, figure out what's going on, we know pretty clearly what is going on in implied volatility. We can use that as the basis of a trade. Anytime you've got something that is changing and predictable, you can use that to make some money. So let's think about a basic calendar trade, a dual calendar, which would be a fairly straightforward calendar trade we worked with last week. You've got a short option, or a set of short options, a short put and a short call. And between those two, you receive a credit. Your goal is to basically stay roughly between the strike prices of those. And as time passes, they erode towards zero, and we lock in the profit from that credit. We can't take that as a trade all by itself because it's too risky. That's the margin required for it will be outrageous. The risk, if it failed catastrophically, would be horrible. We could blow up our accounts. Lots of crazy things that we just do not want to do. On the other hand, if we put in a long option, we give up some of our profitability, but we control our risks. And we also get this secondary effect where if the stock is moving away from the center of our strikes, we actually gain some additional profitability near our strikes. So it creates that interesting little Batman hood looking dual calendar structure. As time passes, we lose a little bit of profits from the long options. Same strikes, just further off in the future, eroding a little bit towards zero, just not as fast as our short options do. between the two, we make out pretty well. Once again, as I said before, it's a situation where in that trade, we believe that everything is moving together as far as implied volatility. As implied volatility goes up, it hurts our short options and it helps our long options. Well, the long options are more sensitive, so that's a good thing, and we make money. But now we get earnings announcements, and something interesting starts changing. In fact, we have something that's pretty darn predictable about implied volatility. This is just one of a ton of different charts that I could pull up. Let's see, Chipotle Mexican Grill. Yeah, there's a nice little one. Price line. There. Google, let's see. Not quite as much, but how about Baidu? Oops. Let me show you what I'm talking about. This right here, the green line in the middle of this swarm of dots and everything is implied volatility. And you'll notice it's got a pattern, almost a heartbeat. You know, bump, 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 bump. It's like an EKG for the stock. Every one of these bumps is leading up to an earnings announcement. And it's for a pretty good reason. Earnings announcements represent a point in time, a brief moment where the company is going to, 4 times a year, release a bunch of really, really important information, critical information about the company. And the market is going to react to it. And everybody's got, expectations ahead of time. What's going to happen? Is this going to be good earnings? Is it going to be bad? What are the estimates? Everybody has beliefs about what's going to happen. But the reality is that when the company comes out with the announcement, that's it. The stock either jumps up, jumps down, maybe does nothing, who knows. The moment in time when that happens represents huge amounts of risks for all kinds of different people. Now, obviously, the option sellers have a lot of risk at that moment because if the stock jumps way up against them, then they lose money. The hedge funds and the money managers have a lot of risk at those moments of time because if they have a large portion of their portfolio wrapped up in this company and it jumps down 20%, well, that could be it for their business. Long-short hedge funds trying to maintain a strict control over their risk profiles. Once again, they have tons and tons and tons of risk. They have to control that, and they're willing to spend money to protect themselves. All of this comes together to drive up the implied volatility of the options. Hey, Harry, how's it going? Good to see you for the second time today. All of this has the effect of driving up the implied volatility of the options. But what's interesting about this, really interesting about this, is that it very specifically drives up the implied volatility on the options that expire after the earnings announcements. So now we're getting into a really, really interesting opportunity. So what if we had a situation where we could do a dual calendar trade, or a calendar of any type, to be honest, where the long options were going to rise in implied volatility, and the short options, remember, rising implied volatility in the long options has a massive effect on the P&L of the trade for us. And the short options were not going to rise in implied volatility. Well, that's what we suddenly get into. We actually create situations where we can basically fine-tune a trade so that we've got the implied volatility rising right where we want it and staying stable or dropping right where we don't want it, where it would hurt us. Now, this is a whole category of trades. We've got 2 core trades that I would say are the primary examples of this, and then we'll tweak and show you a couple others because there's a wide variety of different ways you can do this. But let's dive in. Before I get going, how many of you have seen my earnings trades or the pre-earnings trades before? Who do we have here who's seen that? Actually, more specifically, who has not seen those? Just want to kind of get a little sense of what level we're working at right now. Haven't? Have not? Okay. All right. Well, we're going to go through the whole thing no matter what, but I just want to kind of see where we stand here. Not. Okay. Wow. We have a bunch of, okay, going to be good. All right. We have a bunch of fresh people for this. This is good. A new set of eyes. Well, this is where we finally get into some magic, which I find to be a lot of fun. Let's dive right into the trade. In fact, first one I'm going to look at is, I believe, Netflix. We're getting a lot of attention on this one right now, and I want to show you how this works. First of all, let's lay down a couple of very, very basic things that you need to know. You keep these in mind because they're critical to understanding the trade. First of all, options that expire after an earnings announcement are exposed to risk. Stocks can jump way up or way down based on what's going on with the earnings announcement itself. And whatever comes out from that announcement could drive the price all over the place, or it can do nothing. And there's a whole variety of different possibilities. So if an option expires immediately after that, let's say the Friday after the earnings announcement, there is an extreme level of risk in that for the people who sell the options. There's no time to get out. There's no time to control risks. Basically, all of the bad things line up and create a great big list of why this is dangerous. At the same time, earnings announcements also represent a very, very large risk for stockholders. The people who are trying to control the risks in their portfolio see earnings announcements as one of the either greatest opportunities or worst risks that they have in their portfolio. So they're interested in buying things, and they buy up a ton of those options. So those are the ones that get the most amount of implied volatility. Now, you go out a couple weeks later, and implied volatility does go up, but it does not go up as much as the options that expire immediately after. Proximity to the event, meaning the distance that you've got and the opportunity to adjust, to manage your risks, all kinds of different things, means that there's just less interest in those options out there. There's less volatility increase in those options. Now, the further away from the event you get, the less effect the event has on the volatility of the options. So you see, you get this very, very high amount of implied volatility on the options the closest to the earnings announcement. And then that drifts down into lower and lower amounts until finally you're pretty close to what would just be a normal implied volatility for the options period. On the flip side of that, what happens to the implied volatility of the options that expire right before the earnings announcement itself? Like, let's say the Friday before the earnings announcement. What happens to the implied volatility of those options? No, Curtis, I was actually going to say virgins. That was the word I was going to use, that I really held back, and I tried to avoid saying it, but I'm sorry, it just slipped out. So, Harry, implied volatility on the options that expire before the earnings announcement. Let me give you a hint. Not much. Nothing. Implied volatility goes up because an option is exposed to risk. And options that expire before the earnings announcement don't exist when the earnings announcement happens. The earnings announcement is what causes risk. So suddenly we have these options that are massively, hugely overpriced that expire immediately after the earnings announcement, but we have options that are normal, kind of boring, not very high implied volatility that expire before the earnings announcement. That right there gives us our opportunity. Playing these three things Options before the earnings announcement, little to no effect. Options immediately after the earnings announcement, absolutely the most highest, most significant effect of implied volatility. Options significantly past the earnings announcement have a little effect, but not much. Those are the three pieces we're playing here. All of these things are moving, and they move in different ways, and they can be relatively predictable. From there, we can build out a bunch of trades. So let's explore that. So let's see here. We have a bunch of potential target symbols coming up. Netflix is one of them. On the 18th, which is tomorrow, at 4:05, after the market closes, we are going to have an earnings announcement for Netflix. That's going to be one of our biggest ones. Right now, I want to go a little further out in the future and find something like a week out. So let's see. Amazon, beautiful. All right, perfect. Let me show you exactly what I'm talking about here. Amazon has an earnings announcement on the 26th after the market closes. So let's jump back over to the trading platform. Let's take a look at Amazon's book. Okay, so January 20th, options expirations. We have an implied volatility of, hold on. Let me just double check something here. 25th is the earnings announcement. I'm going to just double check something. Something doesn't look quite right in the options book. Let's see. By the way, if anybody wants it, this is a handy site that I use a lot for this. It's earningswhispers.com. It is awful ugly, covered with advertisements, lots of things that I don't care about, don't care for, but it also has some of the best earnings announcement information out there. Okay, January 26th. All right. But it's not confirmed. That's interesting. I might use something different because that's a little bit odd. Okay, Google. Google is confirmed. It is the 26th. Let's work with that one. Okay, here we go. This can at least illustrate the issue a little bit. We have an we have an options expiration that's coming up on January 20th, a couple days from now, Friday. The implied volatility on that option is 16%. So here we are, relatively normal implied volatility on those options. They expire before the earnings announcement, so it's not actually exposed to any of the risks around the earnings announcement itself. We've got, it's not even going to exist. It's not going to be there when the earnings announcement happens. So relatively normal implied volatility. Now here we are 1 week later, January 27th. This is, the earnings announcement is happening on the evening of the 26th. So basically closing on the 26th, earnings announcement, we wake up the next day, it's expiration Friday, and these options are directly in line to be hurt by any kind of major jump up and down from Google's earnings announcement. And they right now have 36% implied volatility. So that is quite a bit. Now, that is over a week away from now. As we get closer and closer to the earnings announcement, the implied volatility in those options is going to go up and up and up and up. So that right there ends up being a pretty significant opportunity for us to make some money. Now, we'll explore both sides of this, a pre-earnings trade and a earnings trade itself. But we can actually make money on both sides as the earnings announcement approaches and as the earnings announcement passes over. But can everybody see the difference? We've got we've got more than double the implied volatility going from the options that expire Friday to the options that expire 1 week later. All of that implied volatility is generated by one thing, the earnings announcement. And it's all piled up. What's also interesting is it's a really clear example of, look how this has got 36% implied volatility. That's the closest to the earnings announcement. 30% or 31%. 27, 28, 25, 24, 17, and then it kind of just flattens out here and levels off. So we're almost, actually, on the March 3rd, we're just about back to the same implied volatility as the option that has no exposure to the earnings announcement at all. Gives us a really nice pattern, by the way. That's good to work with. So that shows you how the implied volatility shifts, how it moves around. So how do we use this? I'm going to jump back and look at Netflix. Now, remember, this is just 36% compared to 16%. Let's see where Netflix is right now. Oh, yeah. Thank you. How about this? Implied volatility for Netflix on the options that expire this Friday, 3 days from now, have an implied volatility of 118%. That's just now. We're not even talking, tomorrow night is the evening of the earnings announcement. So it's probably even going to go up a bit between now and then. That right there is huge. It's a massive amount of implied volatility. It's just a lot of money sitting there. And it's all built up around the earnings announcement. Now, once the earnings announcement happens, now think in terms of fear, uncertainty, and doubt. As you get closer and closer and closer to the earnings announcement, the time to manage trades, to offset risks, things like that is getting minimal. You're getting closer and closer to the event itself. The risks are getting higher and higher. Fear, uncertainty, and doubt is building up. And it turns into that 118% implied volatility. Now, the earnings announcement itself actually happens. Suddenly, there's no fear, uncertainty, and doubt anymore. There's, confidence, clarity, and I don't know what else. I'm not sure. I don't even have an acronym for it. All the fear, uncertainty, and doubt, poof, disappears. And this goes from 118% implied volatility down to 20, 30% implied volatility, which it normally would be at. If we have an opportunity to buy or sell something at a very, very high price, and then basically buy it back and close it when it drops down to a low price, that's a beautiful opportunity. And this is something that you can actually watch and predict. Now, a couple of things about this implied volatility. Realize that earnings announcements are an opportunity for option sellers, for the market makers to really crank up their prices to a very high level. It's most of the time, I can't say always, but most of the time, it is significantly overpricing the actual risk in the symbol. Now, it can be wrong, and there's certainly plenty of times where it is wrong. But most of the time, it is significantly overpricing the risks because the people selling the options know they've got buyers. They've got those long-short hedge funds. They've got people protecting their portfolios who are willing to step up and pay just about anything to buy that option so that their portfolio doesn't blow up when the earnings announcement happens. Yeah, and Andre, it is famous for jumping on earnings, but you know what else is famous? Option sellers for using that to elevate the price of options even more. You don't care how much the stock jumps. You care how much overpriced the implied volatility is. Use that to define your range and figure out if you're comfortable that the stock jumps are going to land within that range. This is one of the things that's powerful about this trade is it actually automatically adjusts itself based on what is the risk that's coming up. So if you've got a stock that does have a history of jumping all over the place and you're worried about that, you really need to evaluate the trade because what's most likely happening is, I don't know, maybe 118% implied volatility getting pumped into the options, which means that the the strikes you take and the range over which the trade works is going to be massively wide. If it's wide enough to accommodate large gaps, because Netflix sometimes jumps a lot, beautiful, you take it. If it's not wide enough to handle that, you walk away and don't take it. Don't walk away from one of these trades before analyzing it thinking that this stock gaps too much. In fact, we want fear to be around this symbol. We want fear to be here. You know what doesn't gap really at all? Pipeline stocks, because I could pretty much tell you what their earnings are going to be about 4 years from now. You know what sucks for trades like this? Pipeline stocks, because they don't create the situation. We're using that to get an edge. Now, I'm not saying you take a stupid trade. You never want to take a stupid trade. But you do want to use the fear of what you just said to your advantage. So let's take a look. Harry, stock price neutral before since IB gets higher close to the earnings date? Shouldn't we buy 1 week prior, 7 to 10 days? Harry, we've got actually several trades that we're going to do. The trade I'm focusing on right now is the trade that basically is using the drop in implied volatility to get an edge in the trade. Now, there's totally different trades where you would buy 3 to 4 weeks in front of the trade and use the rise in implied volatility. Anytime we've got a predictable, clean, understandable situation where implied volatility is going to change, we can use that to create an advantage. So right now what we're using is the drop in implied volatility. But we have a second trade I'm going to look at in just a second, once we're done this one, where we use just the opposite. In fact, we are out before the earnings announcement ever happens. So all kinds of possibilities there. So I'll show you the sweet spots on all of these, Harry. 7 to 10 days is kind of a dead zone for those trades, though, because you kind of had too much stuff already happen, but not enough of the next thing to happen. So we're usually looking at either 3 to 4 weeks prior or 2 to 3 days before the earnings announcement itself. This one right here, it can literally be a one-day trade. Exactly, Andre. Is this trade that I'm looking at right now, we could be in tomorrow and out the next day and walk away with our money. So that is, and it creates a really good opportunity that way. But there's as I said, I mean, don't try to put this into one category, because there are a bunch of ways we can play this exact same thing. So let's dive in. Here we have an earnings announcement. Netflix tomorrow afternoon. Now, I'm going to be looking at this trade tomorrow, and I really would like to put it on as as basically an opportunity for the group. So understand that right now I'm using old data. Well, not terribly old, but as of 4 o'clock this afternoon, all of this froze. Tomorrow morning, the trade will look slightly different, so don't expect this to be the exact same thing in the morning. But let's walk through the steps to building this trade up. We're going to use a dual calendar to basically capture the opportunity we have here. To do that, we need to figure out where our strikes are going to go. Now, roughly around the 1 standard deviation range, based on the implied volatility of the options that we're using, is a little bit of a sweet spot for the trade. If you put the trade too narrow, you generate a situation where you can make large profits, but the stock can't jump very much. If you make it too wide, you destroy it in another way. The max profit decreases so much that the trade isn't really worth it, and the middle of the trade ends up going underwater, and you lose money. Right around a 1 standard deviation range is a pretty solid sweet spot. So how do we figure that out? There's a bunch of ways of doing it, and I'm going to show you 2 right now. One is already built into Thinkorswim, so that's nice and easy. And the second one is for anybody who doesn't have Thinkorswim, and it's really just about as easy. Okay, what we need to do is I need to find the at the money strike. Here we go. Netflix is trading at 132.89 right now. And I need to figure out what is a one standard deviation range. Now, we deal with one standard deviations a lot, it seems, in options, mainly because the fundamental math under options is based on a log normal probability distribution, and one standard deviation gives us a ton of information about that. It also puts us at a very, very nice spot on the curve as far as the risks and rewards. So the first way that I'm going to use to find that strike price is this. Thinkorswim has this number at the top of every options expiration. It is what they refer to as the market maker move number, or the implied move number, whatever you want to call it. It takes the implied volatility, kind of an average of implied volatilities through a bunch of these, and it uses that to create a hypothetical range that would be a one standard deviation range based on the pricing of the options between now and when the option expires. This option expires in 3 days, Friday. So what this number right here is predicting is that there's a plus or minus $12.47 move or range up and down, which would represent a one standard deviation range. Now, for those of us who are statistically disinclined or whatever, what that really means is, based on the pricing of these options, it is implying that the market believes that 68.2% of the time, the stock will end up between $12.47 above the current price and below the current price on Friday this week. So 3 days from now, 68.2% of the time it would stay between this range, up and down 12.47 cents, or $12.47. So basically a $25 range up and down. Now, I want to point out a couple of things that are actually a little tiny bit of a problem with this. In this case, not horrible, but anytime you're using Thinkorswim, pay attention to what this number is compared to what the at-the-money implied volatilities are. Now, on the put side, we're looking pretty good. I mean, 18%, 18%, I'd say that's pretty much right on. Call side, on the other hand, not so much. In fact, these are off by quite a bit. Quite a bit lower, actually. In general, I find that Thinkorswim has a tendency to overprice this number a bit, just the way they do their calculation. I tend to fall on the inside of that, and that seems to make better trades for me. That's me. You can do what you'd like. I want to caution you, though, as we do this, don't think that making a wider and wider and wider set of strikes is actually all that much of an advantage to you. There's a point where you can kind of fall off the sweet spot on the trade, and the wider strikes really just reduce your profitability and make you lose in the middle and create more opportunity for losses. They don't necessarily make hugely, safer trades. Narrow, you get to the point where you're making a lot of money if you win, but you're creating such a narrow range, it doesn't work so well. So in the case of Netflix, I would probably trim this down to a little under $12. So let's see, 132.89 minus, let's say $12 from now, is 120.89. And the other side of that, going up from that, is, let me see, 132.89 plus $12 would be 44.89, or 144.89. So let's find some strikes pretty close. I can do 121. Perfect. That, I like that. I go short on this one. These are the options that expire Friday. And 144.89, I'm probably just going to go with 145 and go short on that. Okay. Between the two, I have $3.69 of credit. Good to keep that in mind. Okay, I said I'd give you two ways of doing this. For those of you who don't have this number on your system and you don't have Thinkorswim, there's another way you can do it that's actually quite easy. Now, it requires you to think a little bit about what's going on. You want to find the strike that's as close as possible to at the money. So right now we're trading at 132.89. So there's 133. That's probably about the closest right there. If I just create either, it doesn't matter, a long or short straddle at 133, there. So in this case, I went short on the puts, short on the call. It's not quite the same. You can get some, depending on how far off you are from the actual at the money strike, you can get a little bit different, but we came up with pretty darn close to the same number, 1290. Once again, I'd probably err a little on the inside on that one. This is a little bit higher than this one, maybe about 50 cents more, 45 cents more, but not too bad. What's happening is this right here is giving you roughly the same as a 1 standard deviation range at the expiration, just the pricing of the at the money options. So something you can consider. By the way, another approach to this is, let me see, 132.89. You can do 132 on one side and 133 on the other side. And actually, yeah, there we go. By straddling over this number, putting one on one side, one on the other, we actually come up with almost exactly $12.40, $12.40. So if you don't have Thinkorswim, you're not crippled. You can do this very, very easy. It gives you the same thing. Now, we have our strikes. Oops. I had my strikes, and now I got rid of them. 121, 145. Okay. What we have is a whole bunch of credit, and we basically have a nice little, hold on, short strangle. Now, a short strangle's got some advantages. It has some disadvantages. Let's see. If we stayed within the range, this wouldn't be a bad trade. The problem with this trade right now is a couple of things. Number one, a short naked strangle, 121 by 145, is going to have a massive amount of cost. I mean, absurd amounts of cost, because the brokerage doesn't want you taking this trade because it's too darn risky. And if you blow up and lose money, they have to pay for it. They don't want to do that. They don't want to have the lawyers have to go after your house and your car and all of those things. They would rather just charge you a bunch of money so you don't do the trade. That is by far the number one problem with this. Number two problem with it is it's actually darn risky. You don't want to take this. There's no control. If you'll notice, these legs just keep drifting down, down, down on both sides. So that's no good. What we can do, though, is protect ourselves. And this is where we start to play around with the expirations. So the short-term options with the highest implied volatility we're going short on. We're going to play that against something off in the future a little bit. And we are going to protect ourselves by going long. Now, this is where things get a little sticky and they can get complicated. It's hard figuring out what is the exactly ideal, perfect spot that you want to use as the long options. The strikes are easy. We're going to use the same strikes that we used before. But here's the trade-off we're getting. The effective vega, so the change in the price of the options from a 1% change in implied volatility, gets greater the further out into the future you go. So a 1% change means more money on the options the further you get away from this point in time here. But the flip side of that is the implied volatility in those options is actually lower and lower and lower until finally you're pretty darn close to where implied volatility is going to be after the earnings announcement. because all of these have a little bit of implied volatility from the earnings. There's risk associated with those options from this earnings. So therefore, they're overpriced a little. Once the earnings announcement passes, the gap happens, whatever happens, these will go down to their normal implied volatility state. We need to figure out what that is. And then we also need to figure out what we believe is the best expiration for protecting our trade. One more thing to consider. The further in the future you get, the more the more money it's going to cost to buy the long options to protect yourself. And that more expense basically means lower return on investment. So we've got all these trade-offs that are happening. We've just got to find the best spot we can. As a general rule of thumb, if you want to do it the quick way, usually about 30 days out, there's a point where the implied volatilities have dropped, and then they start to level out a little bit. Not quite perfect, but you know, the drops, like here we're going from 118 to 77. Okay, that's massive. 77 to 63, that's a 14 percentage point drop. 63 to 57, well, that's a 7 percentage point drop. 56, 57 to 53, well, 4. You see, each time we're getting less and less and less. We want to try to find that place where it kind of starts leveling out and isn't going to drop too much more. So Netflix isn't being really good on this one. It looks like it's not happening for almost 45, 50 days. I'm going to take a little different approach to it. I'm going to go in a different direction first and then reevaluate this. So one of the things that we're going to need to do is know where implied volatility is going to be after the earnings announcement happens. And this ends up being really, really important. The reason for this is these long options we're going to use. In fact, I'm going to just, by the way, I'm just going to toss these on. I'm not necessarily going to call this my trade, but I'm going to toss these on with a, let me see, where do I have 121 and 145 right now, just so I can illustrate what the trade is going to look like. I'm going to be going long on a 121 put and long on a 145 call. There. So we had $3.69 in credit. It cost us more than that to put our protection on, but that credit offset the cost of the protection. The debit is now $2.43. Okay, that's actually pretty good. The long options we're using to protect ourselves are, we're going to sell those back for as much value as we possibly can. Now, they're not going to drop in implied volatility as much, and they've got a much longer period before they're expiring, so we shouldn't really lose a ton of money on these tomorrow. But we need to lose less than $3.69. There's the critical number right there. Because if they lose more than $3.69, then we are now losing on the trade. That was the credit we have. We want to make more off the credit than we lose on the protection. So roughing it in, here's the rough trade, and this is what it looks like on, there we go. That right there is what it looks like on the P&L chart. Now, I do need to tweak what our long options expiration is going to be. It's going to be important because it's going to help us optimize this trade. We also need to figure out where the implied volatility is going to be overall, because this looks like, hold on, that looks like an amazingly good trade. Really, really, really amazingly good. You know, our break-even point would be between 110 and 160. Even if Netflix jumps a lot, that's quite a range. And we could potentially be risking, let's see, $2,500 to make over $5,000. You know, this almost looks too good to be true. Well, it's because it is too good to be true. We're not accounting for the drop in implied volatility, so we need to go out and figure that out next. So let's go do that, and then we'll use that number to figure out where we want to put our expirations. So how do we figure this out? implied volatility is a pretty consistent thing. It's actually got a similar pattern every single time. Not perfect, but pretty close. Let's see here. Actually, let me answer some of the questions. John, your question was $12.47 plus or minus for the stock price or for the at-the-money option. For both. It is. I mean, actually, it's the at-the-money straddle, but it's the same thing. What the market is doing is predicting what its range is. The higher the price of the options, the greater the implied volatility they're predicting, the greater the range that is a one standard deviation range. So theoretically, a $12.47 at-the-money strangle is predicting that between now and when that strangle expires, a one standard deviation range is $12.47 between now and expiration, or at expiration. It literally is the same. It's interesting how that whole thing works. Now, you can't ever get that perfect because, well, maybe if the stock price is exactly at the strike, you'd nail it just perfect. But there's always little effects in there that'll tweak it one way or another. If you took the $12.47 from the straddle, the at-the-money straddle, and then used that amount to, with the Black-Scholes equation, you have to tweak things a little bit, to basically estimate out what that implies for an implied volatility, and you'd come out with a percent number, and then you multiply that percent number times the current price of the stock, it would come back to $12.47. It's a big circle, actually. Mathematically, it's a great big circle that you can just go round and around and around. Implied volatility is the percentage version of the range that can be converted into a dollar amount, which can then be converted back into the pricing on the straddle, which then can be converted into implied volatility, and around we go again. By the way, that's why I always go nuts about the percentage chance of success that the Thinkorswim has on its as an indicator on its system, because it's actually that same absolutely 100% useless circular argument. It doesn't tell you a single thing. This, on the other hand, does tell you something. It actually says that a one standard deviation range is roughly $12.47. That's useful. Is there a reason why March 3rd has the lowest implied volatility? Let's take a look. Okay, be careful, first of all, about this implied volatility. It may not translate into reality too much. Let's take a look at this. Yeah, you see the at-the-money implied volatilities? If the Thinkorswim programming team was my programming team, and that's what I used to do, I used to manage programmers, I'd be periodically kicking some ass, because I've seen them do a lot of fairly poor quality work around math. Always double check it with the actual at-the-monies. I was skeptical the second I saw that one. I'm not sure what's driving it. Could be a bad data point that they didn't filter out. Could be a variety of different things. But if you ever see something that looks completely out of whack, actually check it against the options themselves. And you'll find very quickly that this actually looks pretty much in line. I would have expected it to be about 44, 45%. Yeah, just a second. Andre, why do you think the market makers are doing anything against us on this one? They're on our side on this one. They want this. Okay, you need to get one thing out of your head. Market makers are not your enemy in the options market. Now, if you just want to go out there and buy long calls and long puts, absolutely they're your enemy. We don't trade that way. And for the most part, we're actually riding with the with the market makers. let me be clear about something too, though. Options markets do not have market makers. There is no such thing as a market maker in the options market. There is a floor broker. A floor broker is somebody who has a license to actually operate on the CBOE or CME floor, options trading floors, and they participate in a very low level in the trading. Don't pay don't pay commissions. Bunch of different things. And so they effectively act as market makers, but there's a very, very significant difference. They are under no obligation to make the market, which is what a market maker's job is. A market maker has a specific obligation in the stock market to make the market, which means that all the time they have an order on both the bid side and the ask side, creating a two-sided market for people to transact within. Now, a lot of times people jump in front of them and they don't do the transactions. In fact, these days market makers are pretty much non-entities, but that's their job. There is nobody who performs that job in the options market. What happens is you've got a lot of people competing for different opportunities to make money in the options market, and that creates the market basically through the competition. So it's a bit different. But what we, and actually it makes it unique for us too, because we actually have the right to participate effectively as market makers. Whenever we sell options, we're doing that. We're performing the role of helping to make the markets. So what we're doing actually in this trade is riding on the implied volatility increases that are being baked into the market by effectively the market makers or the sellers. We're joining them and using it to our advantage. They're doing very similar things, by the way. This isn't some kind of, genius plot that I hatched up in my, in my dark office. This is a pretty straightforward, normal situation that is used to create profits in the market. And there's a reason it exists. This isn't something that just poof happens because we wish it to happen. There's a large number of people in the market who buy options, especially right around earnings, with no intention of making money. And that sounds weird, but they're literally buying options purely as insurance policies with every expectation that if those options go and expire worthless, that's fine. It means that they did not take a massive loss. That approach or that activity tends to jack up implied volatility also. So once again, we're just riding along with the other sellers on a market that is basically inflated. Yay, let's make some money. I don't want to fight the pack. Yeah, and Andre, it's really a big difference in the options market. By the way, I am not in any way claiming that these people are your friends. They're not. Some of them are my friends. Maybe some of them are your friends. But as far as trading is concerned, I would expect them to eat my lunch if they had the opportunity. The thing is that you get to work on the same side as they do. It's almost seamless, and that's why it's different. Like the worst market out there is Forex. Oh my God. I don't understand why anybody trades that. You've got these banks who are basically creating a artificially inefficient market to force people to cross massive bid-ask spreads or, face massive fees that basically locks them into huge profits. Forex is nuts. I think it's gotten better recently, but that is a situation you can't play on the side of the market maker. And it's just basically loaded against you. Binary options. Please, please don't go into binary options. That is the biggest scam in the world. Once again, the odds are just right out of the gate completely against you. And there's no way to even participate on the other side. So please stay away from that market, at least until somebody comes in and regulates it and it's not a legalized fleecing of the public anymore. But regular options are a little different. Um, can we say the options market is the most fear market, which can be manipulated too much? I don't think that there's such a thing as being able to be manipulated too much. You are going in the wrong direction here. Please do not ask for efficient markets. The quickest way for us to all basically go broke is to have efficient markets. We want markets that can go and be, okay, first of all, manipulated is a wrong term. It's completely incorrect. Can they react in wild and crazy ways? Absolutely. Can they be manipulated? There's a ton of misconceptions about market manipulation. And, this was very, very close to the high frequency trading stuff that I used to do. And I can feel pretty good about talking about this. The amount of money that it costs to manipulate a market, actually financially move a market in a way that benefits you, costs you more than the money you can make from the manipulation itself. All right? There's a friction that you have to overcome to financially manipulate the market. Now, could I go into the options market and say, and scream out that, planes are falling from the sky and the end of the world is coming tomorrow, and get everybody worked up and potentially sell at higher implied volatilities? Maybe. That might be possible. I mean, I'm not sure that me running through the options floor doing that would do anything other than get me arrested, but I could do the equivalent of that by firing off fake news and something like that. But that's something that's been going on in the stock market and other markets for a long time anyhow. Penny stocks are horrible that way. I mean, it's a cesspool of exactly that kind of pump and dump strategy. Options market, no, it's a lot harder to do that. It's big enough. I mean, there's some depth in the options market, and I will say this, the people who actually participate in the options market, professionally at least, are a lot more savvy than the people who participate in the penny stock markets. And they don't get manipulated that easily. Now, some people sure, but no. Can they raise the prices and things like that? Sure, but that's great for us. We just jump on and ride it. That turns into a beautiful opportunity for us. It's not easy to manipulate the markets. And anytime you hear conspiracy theories like that, never give credence to some kind of complex, improbable conspiracy that could probably just as easily be explained by a bunch of idiots doing something stupid. That's usually the answer. It's because that's normally what is actually going on. You see some kind of big move in the market. I would say 90% of the stupid big moves that have actually happened in the market were some junior trader on a training system that was typing in, trade $17 billion and didn't realize it was live and pressed the damn button. And that's happened plenty of times. All right. Oh, Harry, there's been some big oops that way. Literally almost bankrupting. Night trading almost lost everything that way once. Trying to think. Penson Penson's a clearing corp primarily. They almost lost everything that way once. Who lets the kids around the big money systems? I don't understand that. All right, let's get back to the trade. Yeah, fat finger moves. Flash crash was basically triggered by that. Somebody who didn't know what they were doing, and they were in a large hedge fund, and they were trying to basically move their positions around, and instead of liquidating over a period of 3 to 4 weeks, they just fired it off all as one trade. It caused the market to collapse, scared off all the market makers. Bid-ask spreads widened way out. all the electronic trading platforms triggered as a, we jokingly used to refer to those as GTFO events. GTFO, I'll leave some of the words up to you to figure out, but it's get the something out triggers within the electronic trading systems, which basically means that they just look at the market, say, I don't know what's going on, no way I'm doing this, dump everything. And that created a cascade failure, which caused the flash crash. So that was another one. Yep, exactly, David. Don't attribute to malice that which can be explained by incompetence. Yep. I always get a kick out of the big conspiracy theories about governments. You know, here we have governments that can barely do things right when they're really, really trying hard, and somehow we believe that those same people are managing a 1,000-person complex conspiracy to do things wrong. Never quite understood that. You know, you don't become brilliant just because you become evil. All right. So, trade. Let's get back to this thing. Somebody was asking about the calculation I had a second ago. What was the calculation that you needed refreshing, or you needed me to explain again? Was it the strikes? All right, if that person could ask how to, I'm not sure I understand the predicted move. Okay. So I'm going to do this as a generic thing, just so that you understand it from a broad, big picture point of view. But we use it in this trade for a specific purpose, which is to try to figure out what roughly where our strikes should be. So let me go through from the beginning. We want to find out what a estimated 1 standard deviation range is on the expiration closest to when we expect to leave this trade, to exit this trade. Now, in this particular case, that is the January 20th expiration. That's this Friday, 3 days off. So what we're doing is one of two things. First of all, you can cheat and use the market maker move number, which is baked right into Thinkorswim. It's right up here, up in this corner. It's the same line as the expiration for the option series. If you don't have that, if you are not using Thinkorswim, and if you're using Thinkorswim, that's just where I would go for it, you can do this. And this is just an estimate, but it gets you roughly the same number. You take a look at the current price of the stock. In this case, 132.89. We want to create what is called a strangle over 132.89. Doesn't matter if we go short or long, it's the same number. We're not trading this, we just want to find the number. So in this case, I'm going to put the put 132, and I would go short on that, and the call of 133. Once again, I'm kind of stepping over this number, and I would go short on that. Now the two of those are going to come up with a price. It's basically the bid-ask midpoint of 132 put and 133 call. You add those two together, and it will come up with a price that is effectively $12.40. And really, it's getting to that same number by roughly the same way. You know, it just happens to be that the at the money strangle, or straddle in this case, or sorry, strangle in this case, prices in exactly a 1 standard deviation range between now and the expiration of the options. So let me see here. Let me just double check and make sure I have the trade where I want it. Yes. Okay. So here, let me show you. 132 put, which is below this price. There. I went short. 133 call, which is just above this price, and I went short. The grand total credit on this trade, bid-ask midpoint, is $12.40. This number is effectively the same as this number. So that is the way you could get it manually without using Thinkorswim at all. A couple of quick little notes. If the price is right on 132 or 133, don't do the strangle version, do the straddle, which would mean that, let's say this was 133 exactly. I would actually go short on the 133 and short on the 133. You really just want to try to get the strikes as close to the current price of the stock as possible. Now, I would still go a little bit on the inside on that, trim that down a bit. Once I get this number, $12.40, I take the current price of the stock and I add roughly $12.40, like I said, a little bit less, and I came up to $144.89. I added $12. I subtract $12 and I come up to $120.89. Now, those two numbers are $12.40 or $12 away from the current price of the stock. That means they're right at one standard deviation range, the outer edge of that, for strikes. So I just picked strikes close to that. I picked a 121 and a 145. So that is the process. Does that make sense? Yeah, Harry, it's 1247, but please, I want everyone to understand this is horseshoes and hand grenades. This is not archery, okay? We are not trying to hit a specific, perfect little point in the center. If you try to do that, you're going to kill yourself for absolutely no return. We're just trying to get close. If you go a little on the inside, the trade tends to be slightly more profitable. If you go a little on the outside, you get a tiny bit of extra range over which the trade would work. In general, I find that the market is, in general, overpricing the risk anyhow, and your best bet is to go a little bit on the inside of that number that I just gave you. Now, I'm not talking about 30% inside of where I'm talking about. Just talking, if you had a choice between the outer dollar strike and the inner dollar strike, go the inner dollar strike. That's all I'm saying. Okay, I think we're good. Now, let's move on to getting the implied volatility. Here we go. And my wonderful wife, absolutely amazing, just brought me a nice cup of hot coffee, so thank you very much. Okay, I needed that. We need to go back in time. Think about the trade that we're in right now and basically put yourself in that trade just back on the last earnings announcement and the earnings announcement before that and the earnings announcement before that. The trade we're doing is the implied volatility is collapsing tomorrow night after the earnings announcement. And the next morning we're going to wake up the day after the earnings and we're going to have a low implied volatility. We need to figure out where that implied volatility is going to go to so we can make a smart choice about this trade. Easiest thing to do is just see what happened in the past. All right, here's my approach. I just go to the chart and I pick up earnings dates. And so that's 10/17. I've got 7/18. 4/18. 1/19. October 14th. You don't have to go nuts. I mean, probably going back 5 or 6 of these is fine. A couple of things that I want you to be thinking about when you're doing this process is you need to keep each of these events in context. Now, what do I mean by that? These are snapshots of a moment in time, and we're going to be looking at the implied volatilities. not every situation is exactly equal to the others. We're going to see a fairly consistent pattern, but you know, if we had the stock gap massively down, well, we're probably going to have a slightly higher implied volatility. If we had the earnings announcement happening during a major market correction, we're likely to see a kind of weird higher implied volatility out of that. We want to figure out the pattern, but we also want to be aware that things can mess up the pattern. We're trying to do a swag. You know, a swag is a scientific-based wild-ass guess. The scientific part is we're going to go back and do our research. The wild-ass guess is you kind of have to interpret it a bit and get a reasonable number. Once again, we're not trying to be perfect. We're trying to be good. So let me get this last one, 714. Up on the Analyze tab, there is something called Think Back. Now, this is the one piece I don't have a replacement for if you don't have Think or Swim. I'm trying to work on a tool that will let us do this. I actually have options data going back to about 2007, end of day data for every option in the market. And I'm trying to create something that will basically extract that and pretty much do the work for estimating volatilities. It's not the easiest thing in the world, still plugging away at it. Now, Think Back allows us to go back in time and see what implied volatility was looking like on certain days. So, going back to October 17th, all right, announcement was that night. We would have been looking at the 18th. Implied volatility, actually, just a second here. Yeah, take a look at this. Here is implied volatility on Netflix, right like we're looking at right now. This is the night before the earnings announcement, or the afternoon before the earnings announcement. 125, 78, 67, 61. As a matter of fact, this looks amazingly like the options book that we've got in front of us right now. And it's probably darn close to what it's going to look like tomorrow. Now, we go forward one day. Boom. Implied volatility all the way back down to 37.9, 35, 34, 35. I'm going to dig into these a little bit. I just want to make sure that, yeah, okay, see? Slap the wrist of the programmers. Why does this say 35% when these are actually 32 and 32 and 33? So I'm going to put my targets down around 33%. All right, go back in time again. July 18th. 18th, we're looking at the 19th. And once again, let's look at this. 109%, same exact pattern we had before. Notice all these implied volatilities. We go forward one day, boom, right back down to 38, 37, 36. So roughly 30 days out or so. These all flatten out, by the way. We're looking at about 34%. April 18th. So the day after that, let's see, here's April 18th. 120% implied volatility, same exact pattern that we're looking at right now. One day forward, boom, drops down. Now, this is, well, let's see what's going on here. A little bit higher, 39, 38, okay. Okay, so a little bit higher than normal. Higher is good for us, by the way. January 19th. Now, we got to be a little bit cautious of this one because this was happening right during the middle of a market correction. So these are very likely to be high anyhow. And yeah. Wow, 168% implied volatility. Same pattern, one day forward, and drop down quite a bit. But remember, we're in the middle of a correction. These ones, I don't think I'm even going to bother with this because they're just not relevant. We're not in the middle of a correction right now, so I'm going to skip those. By the way, that's why I said you need to put it all in context. You can't just assume that every number is equal. October 14th, we're looking at the 15th, and okay, about 30 days out. Wow, 51. That's quite high. Now, I also put more relevance in the more recent ones. If we get a nice consistent pattern for the last four earnings announcements, I'm probably going to pay attention to that. Let's see, 7/14, the 15th, and yeah, okay, these are, oh, okay, there we go. Drop down to probably about 35. 33, 33-ish. Okay. I don't know what happened on October 14th of 2015. Let's see. Yeah, I don't know. Okay, so out of this, I got a bunch of samples. What do I need to do? Basically look at them. 33%, 34%, 38%. Then we get some higher ones, crazy one and 51 and 33. Out of this, I feel comfortable saying that we're likely to hit somewhere around a 34, maybe 35%, but I think 34% is a good target. All right. Once again, just trying to do a swag here, just trying to understand where the implied volatility is going. So I'm going to go back to the risk profile, and I'm going to use the information to figure something out. Now, this is where we have to figure out, is this a good trade or a bad trade? And it's critical that we do this. These two implied volatilities, these are on long options. Now, these are also fairly far off in the future. They're quite sensitive to implied volatility drops. These two, I'm estimating, are going to be heading down to about 34. So I need to figure out how to adjust them. Now, everybody, I always get a question, why don't I adjust these implied volatilities, the shorts? Well, there's a real good reason for it. It's irrelevant. We're getting very, very close. This is going to be Thursday. There's 1 day left before expiration. The implied volatility has very, very, very little effect on the price of those options. I could put a lot of effort into adjusting these, but it doesn't really mean anything as far as the analysis is concerned. It won't make a difference more than a cent or two here and there. So I don't really care at this point. But I do very much care about these, because these are going to drop in implied volatility and go down in value. I need to make sure that they don't go down too much and hurt the trade. So, a little math. I've just kind of gotten in the habit of doing this. 57.9 plus 51.94 divided by 2. I'm just taking the average of the two. My target is 34%. So minus 34%. I need to adjust this by basically 21 percentage points. Okay, if you're using Thinkorswim, it's a little gear up here. I could do a broad volatility adjust of 21 points, or I can go into more parameters and allow me to adjust the specific expiration. That's what I'm going to do. Subtract 21. There we go. That is the answer I did not want to see, but I was worried about. Okay, let's talk about this. What just happened here? We just had the long options, which are protecting us, drop by almost 21 points of implied volatility. They're very sensitive to that. We lost a bunch of money on that. We ended up losing more money than the credit we received. So the middle of the trade ends up going below zero. And this is frustrating. We're sitting here in this trade, or we're sitting here looking at this. I wouldn't take this at all. This is just not, it's not a good setup for us. Now, let me show you what this would look like if it was a good trade. And, by the way, I didn't have this answer before I walked in here tonight, so we went through the steps together. If I had a thought that the target implied volatility was something close to, I don't know, 39, maybe 40. Let's say that I subtracted 15 percentage points off. All right, now that looks better. It doesn't look good, and I still wouldn't take it, but it looks better. You'll notice that the bottom of the trade right here is just a little bit below zero. Every time I adjust this to less of a change in implied volatility, what happens is this whole trade moves up. So if I only took off 10 percentage points, there we go. Now that would be an outstanding trade. As we adjust this, if this was what we felt was going to happen, we would have a situation where our break-even point was at about 154.90. So let's see, $23 above and 113, so almost 20 some odd dollars below. We've got almost $45 worth of range on a $130 stock that is our landing zone. As long as the stock lands in between these, in this general area, we can walk away with a good profit. If it lands near our strikes, our 121 strike or our 145 strike, we can walk away with an exceptionally good profit. But that's not what happened. We ended up having, we realistically assessed this and said that 34 was our estimate of where implied volatility was going to go. And when we adjusted it, this whole thing was too low. It shifted everything down and the trade failed. It's an important thing to understand on this. Do not force these trades. It's either a good trade or it's a bad trade. There's a couple kind of on the edge, but even those I would probably walk away from. There's a lot of opportunities like this to work with, and we'll have plenty of chances to do a ton of these trades. Don't take a trade just to take a trade. Take a trade because it's a good opportunity to make money. So my rule of thumb is this. If I don't see at least about a 10% profit in the middle of this little saddle, after I've made what I feel is a realistic and accurate adjustment for implied volatility, I generally don't take the trade. If I did take it, let's say that we came up with this as a result right here, and we'll try another one. I'll do it a little quicker this time, but if I did take this, if I did come up with this as a result, the next thing I would do is I'd say, okay, middle of the trade looks good. I'm solid there. I would want to know that I could make a reasonable profit. So here I've got about a $2,500 trade, and my max profit is over $3,000. In fact, almost creeping up close to $4,000 over here. I should be able to get a 60 to 70% return out of this, even in some of these middle areas without too much trouble. I could easily put a profit target of 50% on here and wake up the next morning, as long as I'm within a reasonable range, I walk away with a very, very clean, quick profit. I can make some great profits that way. We've done a lot of these over the last half year or so and did very well on them. So those are some of the things I'd consider. Another thing that I'd want to take a look at is take a look at these break-even points. I'm just looking where the lines cross out here. So 113.47 and 154.90. I'd probably just call this 114 and 155. Go to the chart. And put it up on the chart. Visually, oops, come on. Visually taking a look and just compare. Now, previous earnings announcements, yes, we've seen some gaps. Have we seen any gaps that would put us outside of this range? That one maybe. Start poking around. See if the trade has any weaknesses. Do you think that there's a chance that it could fail catastrophically? By the way, even if this were to gap this much and put us a little bit outside of here, that's not horrible. That's just a small loss. What I don't want to see is a history of this stock doing gaps that would blow us way outside the range. That's just not a good situation at all. Let's see, what others? Poke around and see if you're comfortable. Now, what we would end up having if this was the case, is we'd set up the trade and we'd set up a couple of general rules of thumb. First of all, I find that one of the best ways to manage this trade is just put in a good profit target that isn't outrageously hard to hit, that you can just walk away with first thing in the morning. In this case, if we had a possibility of making over 100% return on a trade, I would probably be looking for about a 50% profit. I'd figure out my debit's $2.43. I'd probably put the commissions in there too, so I'd add 8 cents to that, and then multiply that times 1.5. That gives me a number. I could put that in as a good to cancel order that's going to execute in the morning if I can get a fill. A lot of times, if you leave that through the open, you get a fill. You just walk away from the trade with a quick, easy, very little management, excellent profit overnight. So there's one way. Alternately, if you'd like, you can set up a more complicated plan. There are ranges in this trade that act slightly differently. If the stock price ends up somewhere near this strike or near this strike, you have an advantage to leave the trade in until later, maybe even Friday if you want it, because theta erosion is going to create a push on the profits to go up and up and up, and basically maybe even make over 100% return. On the other hand, there's this weird situation. This rounded hump, let me see if I can get it to do what I want. No, it's not going to. Anyhow, the morning after the trade, this hump actually exists in the middle. And the P&L in the middle of the trade can very often be higher than the P&L at the last couple of days. So if you're in the middle, kind of in this range, you would actually want to exit the trade and take your profit then, which is fine. You've got a good profit, not a big deal. As a rule of thumb, I put a line, or I put a break here roughly halfway between the strike and my break-even point. Now, this is my threshold. If the stock were to gap outside of this, and when I was to wake up in the morning and have Netflix trading over, let's say, 150-ish, or 149.50, or below 117, well, it's had an extreme move. A couple of things in my favor. First of all, implied volatility will likely be a little bit higher and buffer me a bit. I should still be able to get out with a potential reasonable small profit or maybe a little loss. What you don't want to do is leave it on and let that stock continue out, which is very possible. So as a general rule of thumb, I put this line up here and I say, where is that? If I drop below this, my rule is close the trade. If I go above this, my rule is close the trade. So we've created a whole series of choices just based on some pretty basic thresholds. You can manage it that way. I've actually gotten more and more away from that and really just look at closing it the morning after. You simplify it. You either make your good profit or you don't. You walk away from the trade. I'd say that there's a lot of advantage to simplifying trades. It's a nice thing. So let me answer some questions here, and we'll see if we can do another one of these and maybe find a better trade. David, perhaps look at 5 and toss the highest and lowest. Sure, that's one way of doing it. You can certainly do that. You know what I found is over time you just got to feel, you kind of build up a feel for it. You can create whatever you'd like. Any time that you see a number that's wildly outside of the norm, you normally can go to that, and it's like a period of time when the broad market has got a very high implied volatility and something is driving it around. You'll see very common things like that. Like I almost always have to edit out the points around the beginning of last year. Just because, you know, January and February last year, we were in the middle of this fairly massive correction and implied volatilities were jacked way up. So I just don't pay attention to those. If I thought we were going to be in that situation, sure, I'd look at it. But that's not the world that we're going to be in, knock on wood. Just kind of create a little bit of a process around it. I don't see any problem with dumping the highest and lowest and averaging the rest. That's fine. What you want to do, though, is you want to try to get a realistic as you can estimate. Don't be Pollyannish optimistic and don't be hyper pessimistic. Hyper pessimistic, you're going to put numbers down there that are super low that you'll never find a trade on. You know, put something that's just too blindly optimistic and you're going to set up a bad trade. Try to work at being as consistent and as accurate as you can, and that'll give you your best results. It's not too tough to figure out, though. I mean, you just do it a few times and you really just fall right into a pattern. Let's see here. Are we going to do this trade, or is this just an example of valuing implied volatility? Well, I would do this trade if it was a good trade, but no, I'm not going to take this trade. I'm going to try to take a trade, but it really depends on whether or not the trade itself is good. Let me say this. I think that in general, you are going to find that about half to two-thirds of these trades are usually acceptable trades and good trades to work with. Now, I will also say that you're going to go through times that are extremely frustrating. When the markets get into periods where there's kind of weirdness happening, and I can't imagine weirdness happening in the world right now, but implied volatilities get a little out of whack. And those are the periods of time where I will dig and dig and dig and search through trades. I just will not find one that works. And it's frustrating. And I'll sometimes go 2-3 weeks in an earnings season and just beat my head against the wall and not find them. Other times, like last earnings season, man, I swear, I couldn't even do all the trades in front of me. I was literally doing trade after trade after trade, and they were all coming out looking outstanding. We made profits on over 90% of these. We had one that had like not even that bad of a loss, but it was not a winner. And we just really did a great job. Some earnings seasons are great. Others are not so good. Be ready for dealing with that. You know, my recommendation is always have this in your back pocket, and as earnings season comes up, go through the paces every time. It's not that much effort. And then if you've got good trades, you take them. If not, walk away. Now, it was frustrating. I was really hoping, actually, I kind of had my heart set on Netflix working, and I was hoping that I'd do it. Here's another thing to realize, though. Tomorrow, implied volatilities are going to be different on Netflix. I'm going to run through that exact same thing again. Now, I'm already going to have my implied volatility target, and that's the hardest piece. Once I've got that, I can punch things in, and boom, I'm working with a number that either works or doesn't. I might find that tomorrow that trade could look great. If it looks good at the time, then you've got a good pricing on the whole thing. Take it. If it doesn't, as I said, walk away. Does seasonality affect this? I'm not sure if seasonality affects this radically. Here's the thing to consider, David. The older the samples that you're using for implied volatility, the less relevance they have today. Realize that over time, companies shift their character. Something that used to be, well, here, actually, a great example of that. I can remember, oh my God, when probably 6 years ago, trading Google, the same style of trade, and man, implied volatility was huge on Google. I mean, just really, really big, great moves. Now, Google's actually kind of boring. They've settled down. People trust them. They've settled into being a kind of a, I don't know, marketing machine, and you don't see the changes as much. It's harder to do a trade on Google now. So things will change over time. So I would say that the most recent 3 or 4 months is about your best estimates of what's going to happen. But once again, keep an eye out for just weird anomalies and just filter that out. Let's see. Why did we look at 30 days out? We set up the trade for February 10th, 24 days out. Well, the reality on that is, let me see here. It wouldn't have mattered what, it wouldn't have mattered too much what expiration we used when we looked for the samples, because they're all going to be roughly the same thing. It's really interesting. We see this great big curve that happens before the earnings announcement, and then right after it, it just flattens out. And almost every single one of them are going to be pretty darn close to the same. So here we've got 47, we've got 47, we've got 47, we've got 47, and we've got slightly under 47. So in all honesty, Robert, it didn't even matter which one I picked. I could have picked 15, I could have picked 24, whatever. If you want to be consistent, use the number of days out that you would expect to use. But I rarely find there's anything radically different. The implied volatilities all fall to a natural level. And there's not really a big difference there. But neurotic consistency is a handy thing for a trader. So good question though. All right, let's do, let me see here. I am going to try one more of these right here quick, and then I'm going to shift over to basically the sister trade for this exact same thing. All right. Netflix is usually Netflix is usually one of my better ones. It's a little frustrating, actually, that it didn't work. Let's jump in. IBM, a little bit more boring, but may actually give us an opportunity. So, IBM, same thing. Earnings announcement Thursday night. Implied volatility. All right, right now implied volatility is at 47.89. As a rule of thumb, one of the things that you want to be paying attention to is you would like to see that the implied volatility of the short option, the short-term option, the one that expires right away, is at least 2 times higher than the longer-term option. So you can see IBM drops from 47, 30, 26, 24, 23, 21, and then really just flattens out here. Well, 47% is twice as much as basically the 20 and 21%. So that's a fairly good indication that this may be an opportunity. If I see something where, I don't know, I have a 32% implied volatility versus a 20% implied volatility, you almost never find a good trade out of it. It just doesn't work very well. It doesn't necessarily matter that this is 100% or 150% implied volatility or even 30% volatility. What matters is that this number is significantly larger than the further out numbers. So we're starting off relatively good here. We're looking at IBM, same situation. I'm just going to grab the market maker move number, which is about $6.31. I'm going to check this implied volatility against, here we go. Here's another one of those wonderful thinkorswim things that just drives me nuts. All right, 47.9%. That's creating a number of $6.31. Reality, at the money, is looking more like 41 to 43% implied volatility, probably averaging about 42. So I'm going to try something. Let's use that strangle method real quick. 167.89. So I'm going to do this. Let's see. I actually think I might have to do both at 167.50. The problem is that I could do 167.50, which is pretty close to 167.89. If I did the 170, I'm very, very far away, and I'd probably get a bit of a bad answer. So I'm just going to use 167.50 and 167.50. $6.01. Okay, roughly there. Got to trim that down just a little bit, but probably right about $6 away. Current price, 167.89, so that means that I'd be looking at 161.89-ish. And I've got a limited number of choices, and this is what's frustrating on IBM. I would like something close to basically 162 or 161.89. I guess 162.50 is not too bad. So I'll work from there. $6 on top of 167.89 is 173.89. Okay, and once again, I'm getting like choices of 172 and 175. This is not good. I don't want to jump too far. I'm going to go on the inside. We'll see how it works, but I'm a little cautious about this. We're getting a $2.31 credit. I want to, by the way, if I do that, I want to be very careful that my break-even points make sense in this trade. So $2.31. I am going to go and find that point where things kind of level off. Probably right about, I don't want to go out to 38 days. I'd really like to keep it shorter. What do I have? I'm going to try at the February 10th. Shorter is better, but sometimes the implied volatility drop is too big. So I've got 162.50 and 172.50. I'm going long and long. Okay, we now have our trade set up. Let's knock out the implied volatility real quick and see if this thing works. Okay, we have 1017, 718, April 18th, February 19th, or January 19th, October 19th, July 20th. That should be enough samples. I'm going to jump back to analyze, think back, and let's see what we've got. Okay. So October 17th. That means we'll be getting out on the 18th. About 18%-ish. Actually, this one's got a little different here. A little shorter term. This is 16%. A little bit different. So it's worth, I guess it's worth poking around a little bit and checking. And this is about 16, 17%. All right. In general, I'm just going to go a little bit on the lower edge of this considering and put it at 17%. Going back one more. July 18th. Getting out on the 19th. Actually, it doesn't look right. Okay, something is messed up in here. By the way, watch out because you will sometimes get some really freaky data. I don't think this is 378% implied volatility in here. Something is messed up, but you can see the actual numbers don't look too bad. So about 17%. Actually a little bit lower on that one. Oh, okay. One side's higher, one side's lower. Averaging out probably about 17% again. Roughly 17%-ish. Okay, going back in time, April 18th, getting out the 19th, 17%-ish. 17%-ish. Actually, maybe a little higher on this one, maybe average of 18%. All right, so 18%. I'm just going to not even bother with January and go back to October. October 19th, looking at the 20th, 21, 21, 19, 20. All right, we'll just call that one 20%. All right, good enough. I've got 17, 17, 18. Those are my last three samples. They're all nice and consistent. Let's generally just look at this as 17 or 18% implied volatility. So, analyze. Looks beautiful. Let's adjust this. Now, this is a big important thing. It's not even so much what the target implied volatility is, it's what the difference between the current implied volatility and the target is. So right now, these two don't really have a huge super high implied volatility. We've got about 20.5 and 25.5. So let's just see what those average out to and figure out our adjustment. Okay, subtract 18. Okay, so I'm going to basically subtract 5% implied volatility off of these two. And that'll, on average, bring us roughly where we want to be. February. Okay, now that looks a little lopsided, but it's not that bad. The lopsided, by the way, is because we weren't able to really nail the strikes too close. We had to make some fairly large shifts as we were doing this. But that isn't that bad of a trade. We might want to think about tweaking the strikes a little bit, balancing this off. But in general, it's actually looking relatively good. We've got an overall cost of $1,700 for these 10. We could make not quite 100%. Yeah, actually, we can make 100% here. Based on what I'm seeing here, it looks like we could relatively easily make about a 30% return on the trade if we put a reasonable target in on the trade. Nice, you know, we don't want to try to go for the perfect max profit. If we made about $500-600 off of 1,700, that would be putting us right at about a 30% return. And that's pretty reasonable to hit across a very, very wide range. I'm a little nervous about the lopsidedness of this, but overall, it doesn't look like a bad trade at all. Once again, the lopsidedness is mainly because we were forced to use strikes that weren't quite where we wanted them to be. We could push it a little bit to try to tweak that, but at this point, I would say we're looking actually fairly good. This right here would be a trade that I would consider taking. Now, before I took it, I need to know that 174.75, or let's just say 175, and 158 are reasonable places. So 158. All I'm doing is I'm checking my break-evens. I just want to know that there's not something stupid about them. Let's see, 175 basically. This allows me to visually double check to make sure that this is okay. All right, historically, what's happened during earnings announcements? A little bit of a move, tiny move, bit of a gap, kind of some of a gap. Well, here we are. We found one that was a bit bigger. Overall, IBM is living up to its name as being boring, which is great, which is where we want to be. I see one move back here that definitely would have knocked us outside of this, although I'm not sure if it would have knocked us way outside of it. So even then, we wouldn't be hurting too bad. Most of these are pretty darn boring, which would leave us in a very good position to hit that 30% return. In general, I'm putting this on my list to review tomorrow, and there's a decent chance I might put this one on. It looks good to me. So is everybody seeing the same thing? Are you understanding what's going on in the general trades? Over the next several weeks, we're going to be ideally doing a fair number of these. So you're going to get a chance to put these on hands-on. But does anybody have any questions right now? Any thoughts? Does this look interesting? For those of you who hadn't done these before, does this kind of does this look like an interesting trade? I'll say this, that when these things work, we've made some great money on these trades. They're short, in and out, with a great possibility for profits. Actually, who's here last quarter? Was anybody here repeating that was here last quarter? Yeah, Robert. I mean, what were you seeing? You were there during the whole process last quarter. We were doing these things fairly regularly. What were you seeing as results out of this? Yes. Okay. Yes. By the way, as we go through these, what I do is, if I'm going to create these as a trade, I'll probably be analyzing and dealing with it first thing tomorrow morning. So probably before noontime, I would reframe the trade. I need to figure out where the prices are, where the ranges are tomorrow, set up the trade again, get it all dialed in, and execute it in my paper trading account for the group. As soon as that goes in, I would be sending out an alert, and you would see the basic outline of the trade, all the strikes, all the expirations, everything you need to do to enter in the trade. After I get that in, I'll do a full write-up which breaks down the how we would manage it, what's the plan for profit targets, risk management, exit, a brief overview of what's the general idea that's getting us into this trade so we understand what's going on, and you will have all the information to do the trade. So yeah, you would get all of that. And then what would be good is that we would be closing this live in the ALTB class on Thursday morning. So that may be an interesting possibility for us. Yeah, Robert, 25%, 35%, 45%. Nice. You see, this is a trade that's got a lot of pieces, and you do have to get your head around that. It's the more advanced trade in the whole series that we're talking about. We're going to take a look at a slightly different version of this in just a second also. I would really recommend taking some time and following along on the paper trades and getting a real clear understanding and actually doing these things. Don't just paper trade as a pastime, just do it as if it was a real trade. Get the experience of how to manage it, how to deal with it, what to expect out of it. Get that under your belt. Once you do that, then you can start to continue on and do these, like Robert's talking about. You're able to duplicate your own trades all the way to Christmas. Yeah, and there's a lot of these trades. There's a big list of them. I can't take them all. And but get the experience under your belt, because these are a little more complicated than your bull puts and bear calls. Is the trade always initiated the day before earnings? Actually, great question, Christine, because that's a good thing to think about. No, it isn't. As a matter of fact, there's another approach to this where I'd sometimes put the trade on even 3 or 4 days before earnings. Now, here's the thing that is the balance that you want to be thinking about when you're dealing with that. The greatest amount of implied volatility is going to be happening literally the afternoon before the earnings announcement. That's when the huge buildup, the final amount of IV is in the options. And that is a really good opportunity. But we're also facing a set of options that are coming very, very close to the expiration of their expiration. They're at the end of their lives. So every day that you wait, you've got this battle between implied volatility pushing the price up and theta erosion actually quite rapidly pushing the price down. If you have an option, if you have a company that's got its earnings announcement on, say, Thursday night, a lot of times you're getting so close to the expiration, it's actually an advantage to you to put that trade on, say, Tuesday or maybe even Monday, 2 or 3 days ahead of times. And I've seen times when, by doing it that way, you actually get an opportunity to close out on the trade for 15, 20% profit before the earnings announcement ever happens. And in a lot of cases, I will just take those and walk away with 15, 20% in my pocket, and maybe I'll set up a new trade, maybe not. I made my money. It is a bit of a balance. I find that the trades that happen on, say, Tuesday and Wednesday nights, or even Monday night once in a while, Those tend to be good if you do them pretty close to the expiration or pretty close to the earnings announcement. The ones that are later in the week, like Thursday night, Friday, especially Friday morning, if you set them up earlier in the week, you can get a bit of an extra advantage. I don't have an analysis of that or a breakdown of the numbers, so I can't tell you for sure what's the best way to do it. But in my experience, that seems to feel about right. Sometimes you lose so much from an extra day's worth of theta erosion on those short options that it actually puts you in a worse position than if you had gotten in a few days early and skipped the implied volatility. So, yeah, Robert, you're right. And it's true. By the way, we're not going to see every single one of these trades win. Don't think that. But in general, what we see is a pretty good, solid percentage of them win. I think we were probably up in the high 80 to 90% range of winners last earnings quarter. And the winners tend to be pretty solid winners. I mean, we see a whole string of 30 to 40% returns on a regular basis, and then we would get a loser. And you have to expect that at some point you're going to get the losers. You need to be ready just to basically wipe the slate clean, close the trade off, and walk away. Don't try to play too many games. You might be right. You might be able to get a little advantage. But I find that a lot of times you end up just kind of killing yourself fighting for that money. We have some general good rules of thumb. If you gap outside of the range that we expect, then you shut the trade down. And if you shut it down first thing in the morning, you usually get out with a minimal loss. In the past, I have seen the biggest loss I've ever gotten on one of these was a 2.5 standard deviation gap by Google, and it caused me to lose about a 50% loss on the trade. Now, it doesn't take many 30% wins to make up for a 150% loss. So I think overall we're in pretty good shape. But it's not going to be perfect, so be ready to manage the trade. Now, Harry, there is an opposite trade of this, and I really do need to take a look at that because we've just looked at one piece of the whole thing. So, any more questions on the earnings-focused trade? Now, this is the earnings event trade. I want to be real specific about the terms I use because I see people getting confused once in a while. We have two trades based on this general concept. One's the earnings trade that you just saw. The second one is a pre-earnings trade. Now, it's actually using the same event and the same general situation, but it's going in a different direction. We're actually starting well in advance of the earnings announcement and using the rise in implied volatility into the earnings announcement to create the trade. And on top of that, we are getting out of the trade entirely before the earnings event ever happens. So that's the next one I'm going to touch on. But does anybody have any questions on the earnings announcement trade? Sorry, Lee, where? I didn't mean to, Lee. Hold on. Earlier question about using IV plot rather than think back. Are you talking about using the history of IV for the symbol rather than think back? You can do that. I find that it's just generally a little bit less accurate. Remember that the implied volatility plot that you get on a chart is not the implied volatility of the options. It's just an aggregated, average number across a whole bunch of different things. And there's a ton of stuff that can affect that. Now, it's not too bad, especially after an earnings announcement. You could look at previous earnings announcements and see generally where things fell down to, and it's probably a pretty decent estimate. But I do find that going back and think back is the better approach. It gets you more accurate information. If you want to do them quick and do like a first pass and figure out if they're going to be a good trade worth pursuing or not, yeah. Start out that way, and if they look good, dig in a little more and get more accurate information. I wouldn't trust the IV plot quite as much as I trust the history. Now let me see. With the current PCLN dual calendar, we're trading the rise in IV, whereas here we're playing the IV crush, but they seem like the same setup. Okay, here, let's actually walk through that because it's a really interesting difference. When we're setting up the price line trade, in fact, let me just jump over to another symbol that we can work with real quick. I need something about 25 to 30 days out in the future that's got a high price, it's got a good rise in implied volatility. Home Depot maybe? Hold on. Palo Alto Networks, there we go. There is the winner. I'll try Home Depot, I'll try Palo Alto. Okay. And I'm going to use this to show you the difference between the two. Okay. First thing, we need to have a symbol that is roughly 3 to 4 weeks, maybe even 5 weeks into the future when it's going to have its earnings announcement. We also need something that is relatively stable, and I might have a little trouble finding that. Ideally, you want to find something that's almost an iron condor candidate that's got a fairly high price, ideally $100 somewhere in that area, $70, those aren't too bad. Let's see. NVIDIA, Disney, definitely not NVIDIA. I'd have a tough one with Disney too. Come on, give me some symbols that work. CRM, maybe? I guess that's not too bad. I don't know. I'm hesitating a little bit because I'd like to find something that's not whipping around a whole lot. We're going to hold on to this trade for longer, and I don't want it to be exposed to a lot of, big moves up and down. Okay, now we're too far out. Yum. There we go. Maybe that'll work. Let's go back to the beginning. All right. I would say Home Depot is probably one of our better bets. Let's see if this works. Okay. Now, Lee, what we're doing here, the last trade we just did, we had our short option, which basically we put on that expired immediately after the earnings announcement. Now, in that particular case, we're focusing almost all of the price action on that short option. And the long options are designed mainly to protect us. They're pushed way off into the future. Now, it's a dual calendar. That's exactly what it is. But in that case, we're using the drop in implied volatility on the shorts to basically collapse that price, from a very high value to a low value. And that's what we're focusing on to capture the money out of the trade. On the trade I'm about to do, we actually shift that around. In this trade, we're starting off with a low implied volatility. So in this case, I'm going to focus on the long options. Now, the long options are going to be expiring immediately after the earnings announcement. In fact, the long options that we use for this pre-earnings trade are probably going to be the exact same expirations that you would use for your short options on the earnings trade. Now, what we're going to do is we're going to be out far enough ahead of the earnings announcement so that implied volatility really has not risen very much in those options at this point. So IV is still fairly low. And we know as we get closer and closer to earnings announcement that that IV is going to go up and up and up, and it's going to cause the value of those long options to increase. Now, the problem that you have is that even though the implied volatility is increasing their value, theta erosion is in the process of eroding their value. Those two factors are fighting each other, and you're not getting very much ahead. So we do this neat little trick. By selling a short option before the earnings announcement, remember that options that expire before the earnings announcement are not affected by the rise in implied volatility. There's no reason. They have no risk. It's not like the stock's going to gap before it knows the earnings. It's just going to kind of trudge along until the announcement comes out, and then it happens. If the options are gone, no reason to have high implied volatility. So what we've got is the opportunity to sell options before the earnings announcement to offset the price of the long options, reduce the cost of the trade. But what's really important about this is the short options have theta erosion in our favor. So what we do is we use that theta erosion in our favor, generating a profit for us, which is just slightly less than the theta erosion against us on the long options. We take and almost negate the theta erosion factor from the long options entirely. So between the two, the short option and the long option, theta erosion is not really a significant factor in the trade, and it basically leaves us with just the value of the implied volatility increasing. So Lee, does that make sense how those two balance out? And it's a little different. We're no longer trying to use the short options collapse to make money. We're just using the short option to kind of offset the costs on the long option and to make our problem of theta erosion go away and let the volatility portion of the trade do its job. So that ends up giving us a pretty decent trade. Avago, let me see. Let's see, 3-2. Yeah, Avago's just a little bit too far out, Robert. That'll be coming up in the next couple of weeks. We certainly should be looking at it, but it's just a little too far out right now. Here's the problem. I'll even take a look at it. Avago, Broadcom, whatever you want to call it. IV-wise, we're in a good spot on this one. We've got an earnings announcement on the 2nd of March. We are okay, here's the thing. When you are dealing with an earnings announcement that's too far in the future, you run into problems. We need to have a set of long options that expires after this and a set of short options that expires before this to make the trade work. Now, one thing to pay attention to is Broadcom is on a tear as far as the direction it's going. You really don't want to have a directional trade. Well, we don't want to take the dual calendar as a directional trade. We could actually get really slick on this and actually do a directional version of this, which is the same thing. We would actually put a target in place, have our short option with a strike roughly at the target. In this case, it would be a call option with a strike of, I'm guessing, about 184, 185. And then the long option expiring after the earnings announcement at roughly the same. Now, the reason I'm doing this is one-sided is because it's a directional trade now. We want this trade to move into that. But the same effect would be driving the trade. The rising implied volatility on the long option would be creating a bigger and bigger profit in the trade while the price movement is moving in the same direction, giving us a bigger and bigger profit in the trade. That right there could be a really interesting trade. You'd need to have March, let's see, do we have a good option for that? We do, although let's see how liquid it is. We have the March 3rds. which would be basically 1 day after the earnings announcement, which is almost perfect, we would need a strike at about 185. Okay, Robert, I would consider this, but probably not today. My suggestion is we wait maybe 3 or 4 days, wait for this bid-ask spread to tighten up just a little bit, get a little bit more activity going here so we can get a cleaner entry. And I think that this could possibly end up being a very good trade. I like the setup as a directional pre-earnings trade. But I do think that this 80 cents in between here is a little bit on the wide side, and I think a few more days of trading and we'll see that tighten up enough that it'll be a decent trade to enter. So that's my 2 cents. Lee, in the case of the pre-earnings trade, the earnings announcement happens between the short option, which is before the earnings announcement, and the long option, which is after. Now, that's just in the case of the pre-earnings trade. On the earnings trade, you're entering the trade before the earnings announcement, but the short option expires immediately after the earnings announcement, and the long option actually expires usually about 3 to 4 weeks after that. So neither of the options are actually before the earnings. You're not bracketing it, you're actually doing it after the earnings announcement. So it is a little bit different. You know what's different about the two trades, Lee, is that it's really how you're exposing either the long or the short to the volatility of the earnings announcement. We're using either the volatility of the short option collapsing to make money or the volatility of the long option rising to make money. And that's the main difference. And you're basically trying to make the option that is going to change in volatility the most be the one that's immediately after the earnings announcement. So if it's long, if you're doing a pre-earnings where you want the IB to rise, the long option's immediately after the earnings announcement. If it's short, then you want the volatility collapsing. The short option is right after the earnings announcement. So does that make sense, Lee? Okay, Whole Foods, let's see. Whole Foods is very often a good trade for this. It's a little low in price, which is a little challenging. The 8th, yeah, you see now Whole Foods is actually getting on the other end of being a problem. It's too short. You really do have a certain window on these. Take a look at Whole Foods implied volatility. Now, in a lot of ways, I like generally where Whole Foods is going, and it might even still be a decent trade. But you notice that the implied volatility has already risen up. My guess is if we dig into this, we're going to find that, really there's not much more room for Whole Foods implied volatility to go up too much more. It might go up, but it's not going to have that really big move that will really benefit the trade. And my guess is Whole Foods we've kind of missed. Now, in a couple of weeks, we'll certainly be looking at it for an earnings trade, but I think we kind of missed the boat a bit on the pre-earnings trade. So there is a bit of a sweet spot. We're always looking for the implied volatility having not moved too much. Let's see. I'm going back to Home Depot and see if I can make this one work. Yeah, you can see Home Depot's implied volatility is still pretty darned low. So we have an opportunity here. All right, let me just see if I can do this trade, and we'll call it good. We'll see if we can wrap it up on this. Robert, do me a favor and if I forget about Avago or Broadcom, remind me in about a week, because that looks like a really interesting trade that we can do in the ALTB class. That will illustrate a slightly different form of these, an actual directional version of one. I like that trade. It could be a good trade. So we have an earnings announcement on 21st. So we need to do a couple things. Okay, looking at IBM tomorrow. All right, Home Depot. We are going to go long on the February 24th, and we're going short on the February 17th. Now, we're using almost the same process. Hold on, did I get that right? Let me just double check. 221. Yes, okay. We're using almost the same process we had before. We're once again using a 1 standard deviation range to find our strikes, but always remember, you want to find that strike or the range as close to the point you expect to exit the trade as possible. And this is going to be on the 17th. So we are looking at 18% implied volatility, 5.95, so basically just under $6, which would put it at 130. And 142-ish. So I'm shorting the 130. This is before the earnings announcement. And the 142, it's a bit of a toss-up. I'm a bit on the outside. I might go down to the 141 to get a slightly bigger profit. I think I will do that for right now, but let's see. 130 by 141. Now, I'm going long on the February 24th after the earnings announcement. Nice, decent, tight bid-ask spreads. That's good. I think this is a trade that we could get in and out of relatively easily, which is a good thing to consider. We're getting a $1.36 debit overall. Now, I'm going to analyze this. And this right here is the same situation we had before. It's not the right P&L chart because we haven't taken implied volatility into effect. We haven't actually paid attention to implied volatility yet. So that's the thing that we have to do. Now this is doing the exact same process we had before. We're going to use the charts, find the dates. Man, I am killing some serious numbers of trees with notepad paper around here. Oh, come on. All right. So here we are. We've got November 15th. We have, let's see, August 16th. May 17th, February 23rd. Now, as we do this one, you've got to realize that it's a slightly different situation. We're not looking at the options after the earnings announcement. We're actually looking at what would the options price be before the earnings announcement. And we really want to know what the implied volatility in the long options are. So we need to think this through. The earnings announcement happened on someday in the middle of the week. We'd be closing the trade the Friday before that because that's when the short options would expire. And we want to know at that point in time what is the implied volatility on the long options. Well, those long options would be expiring in a week, basically after the earnings announcement. So let's go through that. So November 17th. Okay, so I'm going to jump in and go to Think Back. And one more time. So November 15th. All right, this is the earnings announcement. In this trade, the pre-earnings trade, we would be getting out on the 11th. So I'm going to look at that. And I need to be very specific about this one. I need to be looking at the implied volatility options that are after the earnings announcement. So this is 1 week, 7 days in the future. and these are basically 27. So 27. Let's jump back again to August 16th. So we're going back to the previous Friday. We look at the options that expire 7 days in the future, and hey, 27, 28. Okay, let's just call it 28. The patterns are actually fairly consistent. You'd be amazed. The more you do this, it's the same thing happening over and over and over. It shifts over time, but it's almost a nice, consistent, very predictable pattern, which makes the trade pretty comfortable to work with. All right, we're looking at about 33. This one's a bit higher. What was this? This is May. Okay. Okay, 2. Now, this is a February. Hold on. Chart. Oh, 23. Okay. I guess I'm a little dyslexic today. I wrote that as 32. Not really sure how to find February 32nd. Okay, it's the 19th. Looking at 7 days in the future, and you know what? This was actually not outrageous. It was about 33%, 32%. And we'll do one more and call it good. November 17th, looking at the 13 there, and 33, 34. Wow. I wish we were back then. Okay. So the most recent ones were 27, 28. Previous to that, we had a very consistent run of 33%, 33%, and 34%. A little bit tough call on this one. I would probably go with closer to about 28 than I would 33. Overall, is there anything saying that we've got a higher implied volatility market? Not particularly. I would probably not go with 27, but 28 seems like a pretty decent target to me. All right, analyze risk profile. The long options need to go from wherever they're at up to 28%. So we're adding this time. Same thing. I'm just going to get the average of them. 17.36 plus 19.28 divided by 2, 1832. I'm basically adding 10 percentage points of implied volatility to this. Okay. So I want the February 24th to go up by 10 percentage points. This might be pretty decent. And the magic happens. Yes, the magic happens. That right there looks like a nice, solid potential trade. Now, we still have a little bit of sniff test to work on. But did everybody see the process there? The key core concepts of I need to know where the implied volatility is going. I've got the short options basically reducing the cost of the trade, getting rid of theta erosion. The long options are being focused on making money from the rising IV. Generates a pretty good, solid trade. We've got a break-even point about 145 and say 126. Now this is going to be my question right here. Does this basically look like a reasonable thing for the stock to stay between now and, let's see, the 10th of February? So let's just stick this on there. All right, February 10th. Okay. All right, so there's the question. I like the trade. I think the P&L on the trade looks wonderful. We're going to be getting into a trade for about $1,360 with a potential for making just under 2,000. Once again, just under 2,000. I think it's very reasonable. We could be making a 80-90% return on this without really working up a sweat too hard. Maybe maybe even conservative, go for 70%. Lots of room to make money on this trade. So that side of the trade looks excellent. Question is, do we believe that Home Depot is going to stay within this broad range between now and here? It certainly could break out. I mean, we have seen it in the last couple of months do some periods of some larger moves. But in general, it actually looks pretty reasonable. In fact, remember, our goal is not to have the stock run right down the middle. Our best bet would actually to have it move towards one of the strikes later in the trade. That would actually increase the profitability of the trade. So if this one just sticks with this, recently for the last month or so, we've had a nice sideways move. If it just sticks with that for a little bit longer, we could be in a great spot on this. Put out a nice 70%, I don't know, maybe even a little more conservative 60% profit target. A little time passing, a little implied volatility increasing, and this could be an excellent trade. This right here would be a very solid trade. Okay, so did that give you an idea of doing this from the opposite perspective of the pre-earnings trade? Night, Harry. Robert, why did we choose to expand between the short and the long? Probably because I made a mistake and... Oh, yep, because I made a mistake. Okay, thank you for catching that. I'm not sure. I think I was looking at the 17 and thinking it was the 17 and then the 24th. Let me go back and redo this. We shouldn't have actually done that. Earnings date on this is 21st. So trades, I must have just clicked on the wrong one because it should be the 17th of February. So 17th. Okay. Here's something you will run into once in a while. We have an option that is not a valid option for this. So we need to make a decision. 17th of February is a monthly. And when we look at the 130, we have the 130, no problem there. We go to 141 and we only have 140. So we need to make a decision on this. Do we want to take, let's see here, do we want to take the 140 strike, move it in just slightly, which is good for us in many ways, or do we want to use a different expiration? And by the way, if we hold on to this, it would be a little bit longer term of a trade. So I think at this point we probably could do the 140. We need to match that on both sides. It's a 92-cent debit. See, this is what happens when you've been trading literally all day long. I'm very, very tired right now. We've still got the right target on the implied volatility. Everything is good. Let's get rid of this. Okay. Now we have a little bit of a different picture. Good catch on that, because we might have just assumed this was a good trade without taking a good look at this, and you did catch that, so thank you. This is looking a little different. Using the February 17th, and by the way, we can't just use the February 10th. The problem with this is I'm assuming that the implied volatility on these has gone up more than it would have by the 10th. We've got another whole week of implied volatility increases in this. And so this is probably the more accurate picture. So let me see, Robert, yeah, you caught that one. I appreciate that because we would have been coming up with the wrong answer. Here's the thing. We don't have as good a trade on this one, but I want to show you something about this. It's not as bad as you might think. In fact, it would change the way we did the trade slightly. We've still got peaks which are quite high and quite profitable. We could still take this trade, but what we would be looking for is a bit of a smaller profit target in the middle, and we would not let this get too close to the end. Because watch as it goes back. Okay, here we go. It's hard to model this in this, but we get this point as we're getting close to the end of the trade where the P&L of the trade will actually have this area in the middle, which the P&L is quite solid. Good possibility for the trade. In fact, we could probably still hit a good 40-50% profit target in the middle of this trade, but we would need to focus on getting out earlier rather than leaving it till the very last minute. And we'd be relying on that to make the trade better. If we leave this till the last minute, basically let the trade go to the very end, we've got a couple of things that I'm not as excited about. First of all, the break-even points have narrowed quite a bit. So that's a little bit worse. I need to double check that. And the bottom of the trade here is very, very close to zero. Now, this form of the trade, the peaks, only happens in the last 3-4 days. Prior to that, our max profit is actually in the middle of the trade. It comes up, kind of creates a rounded hill, and if you're in this area early, the beginning of the last week of the trade, you would close it out, take your profits, and walk away. But if you leave it till later, what happens is the P&L actually drops. It would increase near the peaks, but drop in the middle, and you would lose out if you kept it on. We could still take this. I'll tell you what, I really want to take a look at this tomorrow when the market opens up and we get some live quotes. I'd be a little bit concerned about this one, but I think it still has a chance of making a decent profit. I don't like the P&L being so close to zero in the middle here. And I don't like the way that the break-evens have narrowed quite a bit. So this is almost 127 by, say, 143. Let's see. No, it's actually not that bad. 127 by... You know, overall, it's still not that bad. All right, this one's definitely one worth looking at, although I'm a little bit more nervous about it than the one that I thought we had a second ago. See, anytime you get something that looks really, really good, always worth double checking to make sure you didn't make a mental mistake on it. And it's good having a bunch of people around to catch your mistakes, so thanks. Let me see, Lee, when I adjusted the IV up, shouldn't you also change the date of the graph? All right, this is the problem that's challenging about modeling these trades date-wise in this. The implied volatility doesn't come in on a straight line. It actually kind of curves up and peaks up near the end. And to accurately model this, you would have to estimate what the implied volatility would be on each date, and then change the date, change the implied volatility, and shift everything around. It's possible to do, but it's an enormous amount of effort, and it's really a pain in the butt. I wish we had a better way of doing that. Thinkorswim does not handle that very well. So, all right. Anything else? Does everybody understand the concept of this one? By the way, we're getting almost up to 10 o'clock, and I am making a bet that everybody is pretty much ready to pass out. I haven't passed out because I think I've got just, I don't know. I keep moving at this point. I'm wiped out, tired. The questions I've got for you tonight, do you see the possibility of these two trades and the general approach in general, and the big picture approach. Do you see how the idea of using events to manipulate the volatility in either your long options or your short options in the calendar spread can basically get you a really solid advantage and build a big edge into a trade? I mean, I think that's the core concept I want to show you tonight. We've gone over a lot of little details on how to make the trades work. We'll have plenty of time to actually put them into play and practice them and do them over and over again. So you need to have that in this trade. There's a lot of, well, as you saw, I mean, there's a lot of little ways to trip up and make mistakes. I'm tired. It's almost 10 o'clock at night right now, and I just made some mistakes. So, and I'm the one teaching the trade. Doing the trade over and over and to see the different ways that it can win and it can fail and it can work is probably one of the best ways to be able to be good at this trade in the long run. This is one that needs practice. But the concept itself behind it is also a really, really powerful trade. Robert was pointing out Avago, Broadcom. We can actually do this exact same concept on that, but instead of doing a dual calendar that's basically designed to work sideways, we can do a direction. We can actually do a directed bullish call calendar that allows us to basically use the rising implied volatility in the longs to leverage up the trade even further, uses the price movement of the stock towards the strike price we're using to make a lot of money, and turn it into an amazingly good trade. Very, very powerful trade. But you need to know how the implied volatility piece works in there. So as long as we nailed that and you're understanding that and get the basic ideas, I'm pretty happy with where we've gotten tonight. Are the wider break-evens on the magenta line valid? No, they are absolutely not valid. The reason for that is Thinkorswim is not letting me change the implied volatility dynamically as we go. So what it's doing is it's assuming that the implied volatility that we expect at the end of the trade exists all the way at the beginning of the trade, and it is distorting that P&L line badly. I was kind of trying to show off a little bit with it, but I shouldn't have even tried to do that. It is not a good thing to do. If you want to see that accurately, you literally need to estimate where implied volatility is on a daily basis and adjust it for that day, set the date, and then see the P&L line for that date. And that's not an easy process. Certainly, Thinkorswim doesn't give you a good tool for it, that's for sure. So please ignore the purple or cyan, whatever it is, line that was there. The most accurate representation is the P&L at expiration, which would be correct. Now, I can kind of help you visualize what it would look like because I know, but I don't have a tool for making it work easy. So, did that explain it, Lee? Yeah, sometimes we're victims of our tools. We just can't, I can't make it do what I want it to do. Yeah. Who knows? Maybe, Doe is coming out, or is it, what's the Doe? Yeah, they're coming out with a new brokerage platform. It's actually live now, and I'll be interested to see what they come out with for tools. That was Tom Sosnoff, and he was the one who founded Thinkorswim. Personally, when he was managing and owned Thinkorswim, it was developing and growing in a good direction. Ever since TD Ameritrade bought up Thinkorswim, it's kind of stagnated. So I'm really interested to see what happens because we need new tools. And there are lots of things that would be good to be able to do and just haven't been seeing them come out in the market. Tasty Works. Yes, Tasty Trade. There we go. Yeah, Clifford, I'm actually really curious. I've actually already called them up and talked to them. They don't have a paper trading platform and probably won't for a few months. And it's probably in a bit of a raw state at this point. But as we get closer to that actually working, I'll give them a call again and talk with them about getting a demo version to play with, and maybe we can take a look and see what it looks like, and see if it's a decent platform. It's the Tasty Trade and Doe have what I would consider an opinionated platform. Like, the system that they have is very focused on thinking about things in a certain way, and Thomas Osnov's way, which is good. I mean, it's not bad. He's a bright guy. He understands this stuff well. I think he encourages people to trade a little bit overly actively, but that comes from being a broker. But if you want to do things different from that, it's a little hard. So it'll be interesting. I'm really curious to see. Certainly is good to shake the market up and maybe kick Thinkorswim in the butt a bit, get them to actually fix some of their problems and put out some new tools. All right, I am going to wrap things up. Anybody have any final questions? Yeah, Lee, I've actually played with a version of it also, just briefly, but I think it was a real early version. My sense is that they've got a long ways to go before it's a real full trading platform. I think they're pushing really hard to get a workable platform out that doesn't meet everybody's needs, but it meets most people's basic needs. And they'll probably grow it from there. But if Sosnov does what he did back at Thinkorswim, when he was in charge, they constantly pushed the platform to grow and be better. And I definitely respect that. That's something I'd like to see. The TD Ameritrade, they kind of came in, they cut the programming staff, they cut the support staff, and they tried to basically squeeze it for profitability. And it's, they do make progress in new tools, and things have been a bit better lately, but I really feel like Thinkorswim has stagnated for the last couple of years and just has not put the effort in it needed to stay a top-notch platform. Andre, I'll see what I can do on that. Yeah, that's fine. Let me see what I can do. Andre's talking about in the live platform on Thinkorswim, they do actually have some interesting brand new tools for earnings analysis, and which puts me in a little bit of a tough place because they only enable it on the live trading platform. And I can't use a live trading platform here, but I could take some snapshots and show you what it looks like on the live platform and bring it over, and maybe we can take a look at it. I'll see what I can do. All right. Have a good night, everybody. I will see you on Thursday morning for the ALTB, and then we are going to wrap up. Next Thursday evening is the last session. We're done. What's going on? What am I going to do with all my extra time at night? Well, everybody, good night tonight. Thanks a lot. I will see you all, say, Thursday morning, and good luck with the trading. I'm hoping, fingers crossed, that we're going to have some earnings-related trades in the next couple of days. Keep an eye out. I will send out alerts, send out the full trade updates. You'll get everything as soon as I'm done. Thank you very much, and goodbye.